You use money on a daily basis. But are you able to explain exactly what money is and how it works? In this video, we explain money in 5 levels of difficulty, from child to teenager, college student and grad student, and finally, expert. Find out at which level you learn something new. You can use money to buy things. For example, if you want to get some ice cream, you can give some of your pocket money to the store employee and get your cone in return. Money comes in many forms and can be the coins and bills in your pocket, in your piggy bank at home, or in your savings account at the bank. These coins and bills have different values. You can have coins from 1 cent to $1 and bills from $1 to $100. Now, when you want to buy a pack of gums, you might only need a few coins, but you will need a lot more when you want to buy something bigger, like a new bicycle. The good thing is that money can be saved to use later. You might not have enough money today to buy that bicycle, but if you save up the pocket money you receive from your parents, you might be able to buy it later when you have saved enough. Different countries use different types of money. For example, when you go on vacation with your parents, the money they use will look different. But the idea is the same, and you can still use this money to buy your ice cream at the beach. You just have to exchange the money from your home country to the money of your holiday country first. Your parents have to work to earn money. This helps them to pay for everything. Other adults have to work for their money as well. They might have different jobs, from police officers, firefighters, mail carriers, servers, and flight attendants. But they're all paid in the same money that they can use for things they want and need. The easiest way to think about money is to think about how the world would look if we did not have it. If there's no money, then for every item you want, you would have to provide another item in exchange. For example, if you're specialized in fixing cars and need food, you need to find a farmer with a broken car. There are 2 problems with this. 1. What if the farmer does not have a car that needs to be fixed right now? And 2. What if the fair price for your work to repair the farmer's car is equal to 100 eggs? That's a lot more eggs than you need or could use before they go bad. Having to find specific people to trade with makes it very difficult for you to specialize. Without money, you probably wouldn't be able to specialize as a car mechanic full-time, as you would need to plant some food in your garden to avoid starving during those times where you cannot find a farmer with a broken car. With money, you don't need to find that particular person. You just need a market where you can sell your goods and services for a common medium of exchange. That is money. You can then use that money to buy what you need from others who accept the same medium of exchange. Money also holds value over time. You can repair 1 car today and then use the money to buy 1 egg every day for the next 1 month rather than receiving 30 eggs all at once. Many different things have been used as money over the years, from shells, peppercorns, gold and silver coins to paper money. At first, things that were used as money were considered valuable because they had an alternative use. You could use peppercorns to flavor food, and the value you place on such consumption provided a floor for the value. Black peppercorn was used in the 12th century during the Civil War between England and France to pay rent, as coins were scarce, and unlike silver, peppercorns could not be reduced in quality or value. However, the main problem with using food is that it cannot be stored forever. Peppercorns begin to lose their flavor after a few months, which reduces their value. Other strange things that have been used as money in different countries around the world. Tea bricks have been used in China, Mongolia, and Tibet from the 19th century until the beginning of the Second World War, when the value of tea skyrocketed in many parts of Asia. Its value depended on the quality of the leaves and the distance and accessibility of the market. Tea blocks were favored over coins as they could additionally be used to treat coughs and colds or eaten if food was scarce. Parmesan cheese is accepted by one bank in northern Italy as security for loans, helping cheesemakers during periods of recession. The bank's warehouse holds 17,000 tons of cheese, valued at almost $200 million. The bank allows loans up to 34 months, which is the amount of time it takes for the cheese to age. Bottle caps were accepted as money in Cameroon in 2005 when a brewery started a competition where buyers could win prizes under beer caps. Prices ranged from mobile phones to luxury cars and started to be exchanged instead of money. Mobile phone minutes became a popular alternative to money in countries like Kenya, Nigeria, Egypt, or Zimbabwe in 2011, and are still used today. People use their prepaid minutes in exchange for cash or directly to exchange goods and services. Over time, gold and silver became more widely accepted as money. Because there's only a limited supply in the world, they already carried some value. And unlike peppercorns, they do not lose value over time. Gold and silver was also much easier to divide into smaller and standardized coins. The main problem with using gold and silver is that it's very heavy to carry the actual metal around to exchange for goods. In particular, for wealthier people, carrying an ever-increasing amount of metal coins became a flawed system because they were heavy, drew unwanted attention, and were just terribly impractical to deal with, especially when making large purchases. People found it much more convenient to deposit these precious metals at banks, who would issue paper receipts confirming your ownership of the gold and silver deposits. Anyone with the receipt could go back to the bank to claim back the gold and silver. This was the start of the widespread use of paper money, which triggered a financial revolution that would forever change the global economy. Looking at some of the earlier versions of the US dollar, these are explicitly labeled as silver certificates, indicating that there is a deposit in the US Treasury for $1 in silver payable to the bearer of the bill on demand. Similarly, there were gold certificates, with values all the way up to $10,000, which also confirmed the existence of a deposit in the US Treasury payable to the bearer of the bill on demand. This way, people were able to rely on these paper bills as if they were actually worth $1 in silver or $10,000 in gold. If you actually handed in your certificate, you would receive a real silver dollar made from actual silver and which would also count as official money of United States. So if you didn't trust the US government anymore, you could exchange your certificate, melt the coin, and other people might still value the metal itself. These coins were known as commodity money, where the unit of exchange that we are using as money has value in its own right. This is different from representative money, which is printed on paper, which in itself doesn't have a lot of value, but the piece of paper could, in theory, be exchanged into the precious metal. Eventually, money became completely delinked from gold and silver. After the Second World War, a lot of the world's currencies were pegged to the US dollar, which in turn was pegged to gold at a rate of $35 per ounce. Under this system, when other countries started to no longer trust the US dollar, they converted their money into physical gold. The gold reserves of the United States, which controlled 2/3 of the world's gold after the Second World War, were depleted so quickly that in 1971, President Nixon stopped allowing this conversion. And thus, fiat money was born, a currency that is no longer backed by any commodity, such as gold. Nowadays, the value of money is no longer determined by the underlying gold or silver, but by social and legal consensus. Money is basically backed by confidence. The US dollar is backed by the confidence people have in the United States, the British pound by the confidence in the United Kingdom, the yen by the confidence in Japan. The value of one currency compared to another, therefore, fluctuates continuously. The term fiat refers to decree or a declaration, meaning that the United States government has declared that this is money, and just this declaration gives money its value. Looking at the current $1 bill, this now no longer has any reference to silver or gold. The note is still labeled as legal tender for all debts. So as long as you trust that the government will enforce its laws, this note has value. Legal tender is anything recognized by law to meet a financial obligation, and anyone you owe money to is legally required to accept this piece of paper as payment. Fiat money is more efficient than commodity money, as adjustments to its supply does not depend on the finite amount of precious metal available. But it adds its own complication. If there is no limit to the amount of banknotes that can be issued, how do governments know exactly how much money to print? On the one hand, governments will always be tempted to print more money to encourage spending. On the other hand, printing too much money will increase prices, leading to inflation, and trust in money will be eroded. To remove this temptation to print too much money, most countries today have delegated the issuance of money to central banks who assess the economy's need and who will not transfer money to the government to finance spending. Our world is moving towards a cashless society fast. You can now swipe plastic cards or tap your smartphone to pay for things. The term printing money is no longer appropriate, as most money today is not in the form of paper currency but in the form of digital bank deposits. If you take a $100 bill to your bank to deposit into your savings account, the bank will take your money, put it in its vault, make a few entries in its computer system, and the $100 now appear in your statement. You converted a physical note into a digital number you can now see in your banking app. So far, so good. The next customer comes in and would like a $100 loan from the bank. The bank will not hand this person your $100 bill you just deposited. It will similarly make a few entries in its system, and this person will see the $100 appear in their online account. There are now 2 bank customers and each see $100 in their accounts, whilst the bank only holds $100 in their vault. How far can banks push this? This is managed by the central bank through a metric called the reserve ratio. The reserve ratio is the percentage of deposits that commercial banks must hold on to as reserves, rather than lending out in case of mass customer withdrawals. This is a requirement set by each country's central bank, which in the United States is the Federal Reserve. The Fed can decrease the reserve ratio to give banks more money to lend and boost the economy. The Fed can increase the reserve ratio when it needs to reduce the money supply and control inflation. Reserve requirements around the world can range from more than 20% in Brazil to 1% in the Eurozone to 0 in the United States. In the US, during the COVID pandemic in March 2020, the Federal Reserve completely eliminated the reserve requirement due to the global crisis, meaning that banks are currently no longer required to keep any deposits in their vaults and can lend all of their money to their customers. One of the critical functions of a country's central bank is to control inflation, but also to maintain public confidence in the banking system, precisely because banks are not expected to hold cash to cover all deposits. Because of this, every bank is insolvent by design. This is particularly dangerous in the information age, where people are generally more informed and information spreads instantly. In March 2023, we saw the first social media-fueled bank run when customers of Silicon Valley Bank became alarmed the bank was short on capital. Word spread quickly on social media, and customers started to withdraw money quickly. Depositors withdrew $42 billion in a single day. This was the largest bank run in history, and one that no bank, no matter how well capitalized, could withstand. This experience exposed a glaring new risk to the financial system that regulators do not yet know how to manage. If you enjoyed this video, please like and leave a comment. And if you want to see more content like this, please subscribe to my new channel and turn on notifications.